To you yesterday after another brutal day on Wall Street, down almost 1,200. We're down another almost 1,000. Now here we go, down 1,000 points. If we close down 1,000, it's the third time this week we have seen a more than 1,000 point drop in the Dow. What would you be telling investors to do right now?
I think one thing very important for investors to realize that over 90% of a stock's value is its profits after 1 year, after the next 12 months, which means that even if profits are wiped out for 1 year and we return to normal after a year, let's all hope, over 90% of the value of the stocks should be maintained. We've already had more than a 10% drop. Now, that said, we all know from last October, and I was on CNBC saying that, we were in a momentum-driven market that got too high. I said, it was the type of a market that if anything went wrong, a little pebble on the road, it would derail. Well, we didn't get a pebble. We got a boulder with this coronavirus. So, wow, yeah, you're going to get all those people jumping off that. We were a bit too high there. That rise, a lot of that rise really wasn't justified. We're really back now to levels that I think are really getting very reasonable. Again, fear is the greatest motivator for stock prices in the short run, and it can outrun any of the fundamentals. I'm just saying stocks are long-term assets. Try to look forward beyond the next few quarters to get the value of equities.
It's really important advice, Dr. Siegel, but how can you say that valuations look reasonable here if we just don't know the sort of scale and magnitude of what we're looking at in terms of an economic shock from this virus in this country?
Well, it is true we don't know what the impact is going to be for 2020. Now, do we think that it's going to return to normal in 2021 and 22 and 23? I think the odds are overwhelmingly yes. So you have a big question mark for this year, and then we return to normal. If you do the math, and I teach finance, 1 year that's bad, the rest years that come back, that doesn't mean that stocks should drop 50%, 40%, 30%. Yes, a wobble. To be sure, a sell-off, to be sure, but it doesn't destroy the fundamental values of equities. And I think we have to be anchored in that. Short-run uncertainty, a lot of it, but I think we have to think long-term uncertainty is not at all increased as a result of this virus.
Right. But in an era in which we're used to pretty nice gains almost every year since the crisis, Jeremy, are you characterizing 2020 as a lost year of sorts?
Well, listen, profits were way too high. They were predicting 10, 12%. That was silly. I thought 5%. With this virus, it could be minus 10%. It could be minus 20, 30. Or if we return to normal after that, yeah, it could. I mean, if there's a panic and we just totally shut down the economy, I mean, look, what's going to happen in China if it happens here? I mean, they've suddenly shut down the country. Yeah, we could have a 30% drop. I'm not saying we will. I'm just saying it's possible.
If we do, we're going to have a recession then, aren't we?
We might have a recession. I don't think we're going to have a recession in the United States. We could have a recession in the United States. And it is true. Recessions, most of the time, have been associated with a bear market, which is 20%, which I guess is another 7 or 8% from where we are now. Not always, but sometimes. One of the good things about this, again, I think this could be really bad in the short run, really bad. But when I look further, I have more confidence than like after a Lehman crisis, which basically froze credit for years and with the whole viability of the financial system.
Yeah, although
that being said,
I'm listening to you, Jeremy. I'm not getting necessarily positive. I mean, you're talking about 20 or 30% declines in earnings, a potential
with a
recession,
serious,
and yet
with
you seem to want to be positive.
30%. Well, I would say in the worst case scenario, where everything shuts down, could we have a 20% drop and 30% drop in earnings? Yes. For 1 year. During the financial crisis, we had an 80 or 90%, and then that went on for several years because the entire financial system shut down and no one wanted to take risk, and all those overpriced assets were in a collapse. This is serious but limited.
Right. It sounds like you're trying to.
It doesn't have.
It sounds like you're trying to describe the difference between a very large demand shock, a very large supply shock, but not systemic risk. Is that where your head is right now?
Yeah, not something that systemic risk into something that I think is going to persist year after year after year. Oh, and then maybe we'll get out of it, like the early stages of the financial crisis or the Great Depression, or you go back to other really crises that lasted a long time. This is a severe one-time shock, if it comes to that. But then I see a spring back, and that is what gives me encouragement going forward. That said, by the way, we talked about, I think the Fed should lower rates. I mean, the Fed, look, there's trillions of dollars of loans, LIBOR, et cetera. Let's lower that rate, make sure there's no financing problems there. I'm not going to say that's going to solve the crisis or is a cure-all, but I don't think it makes sense right now. Cash is yielding 1.6. We hear that the 10-year is at, 115. That doesn't make sense to me. I think the Fed should act again. Just let's make some room there for easing on the financial side.
Well,
I
Kevin
see this
Warsh,
as a very severe one-year shock, and then a bounce back that could be extremely rigorous.
Jeremy, Kevin Warsh, former Fed governor, was on Squawk Box this morning after he published an op-ed calling for the Fed to lower interest rates, calling actually this morning a step further for global coordinated central bank action. Listen to what he said.
Sooner they cut, the better. If I were giving them advice, I would say get to this weekend, take stock, reach out starting at the close of business today to the world's central bankers, and at the very least on Sunday night before markets open, have a unified statement from the big central bankers in the world that they are all over this. It's a signal to businesses out there that they shouldn't decide to give up on 2020.
Would that really do anything to help?
I think it will help. Yes. Will it cure everything? No, but I think he's right. I think we should have a 50 basis point cut, and I would like to see other central banks around the world do the same. It cannot hurt. It cannot hurt.
You just said we might have a recession, which obviously may be already being reflected in equity prices right now to some extent. But what happens if we do? And what are we working with? 1.75 in the Fed funds were something like that, right? So wouldn't we be getting rid of all our ammunition? I mean, if we cut 50 basis point now, and then we have a recession come the fall. Say again.
There's always more
ammunition. Then we go back down to zero. That's true. And
then we go to QE,
we were 7 years at 6 or 7 years at zero in the early stages of the financial crisis. And, I mean, in a way, that helped prevent it from going like the 1930s. Well, we finally did the right thing, which we didn't do back in the 1930s. We gave the banks all the reserves they wanted. We lowered interest rates as much as we could. That doesn't solve the world, but it prevents from a repeat of the greatest economic contraction in U.S. history, which was the 1930s. So, yes, that helped. It does not solve the problem completely. It helps. Concerted action, I think, would.
What are the Europeans supposed to do since they're already there? And another thing, Jeremy,
they're already there.
I mean, Greek yields in Greece are going up because people are now worried about their ability to service debt outright.
Correct. So what you got is that the risk, we now get the spread between the sovereigns, the AAAs, the German bonds, the U.S. bonds, Japanese bonds, which are the AAA sovereigns, the rush to safety is going to them, and all other credit risks are expanding. So Greece, even Italy, of course, it has some of the virus, and then you get the single A credits, the B credits. We're going to get a widening. We're not going to get a widening like we had over Lehman Brothers, which was extreme. But we're going to get a widening credits. There's no question about that. This is very predictable, very normal.